To the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now, here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, the main man of the hour, AJ Brown. Good morning, AJ.
Hello, Cyprian. Hello, everybody out there.
Today is August 4th, episode 92. We're in the middle of the summer doldrums, but there's a lot of news coming out and we're taking it in. And so, AJ, where do you want to begin? What are you keeping an eye on? Where should investors, our viewers, be leaning in on to take advantage of opportunities in the market?
Well, the first thing that I always teach my program participants to do when they sit down at their trading terminal, their computer, and start looking at the markets, and I usually recommend they do that outside of market hours, after the market's closed, to kind of take an assessment of what's happened so that they can plan what to do next. I always take them to tell them to take a look at the broad market to get an idea of what the tides are doing, because there's so much correlation between the broad market, the sectors, and our individual symbols, whether they be stocks, ETFs, or symbols that are the indexes. And so let's take a look at the broad market.
And basically, from last week, we said that we were looking for a pullback. You got your pullback.
Yeah. I mean, I am blown every time. I should get used to this because I have gotten so good over the years at looking at the markets. A lot of people who come and they're new to investing think that there's a lot of science and math in the markets. But in reality, the markets are a representation of human behavior. There's more psychology 101 in the markets than there is, like, for instance, algebra or calculus or anything like that people foresee. I'm going to have to learn how to do math. It's more like you got to learn how to read people or read groups of people, because that's really what the markets map is, kind of the groupthink or the tribal behavior of human beings, investors. It's just an amazing psychology experiment. So yeah, every time I'm looking at these patterns, usually through back testing, where you have the benefit of hindsight, and then you make decisions and predict what's going to happen next. When you're right, I'm always amazed, even though it's happened so many times, because I hate to say this, but human behavior is quite predictable.
And so we were looking for a pullback. What was the driver for this week's pullback? Because we did get a slew of information, whether that be earnings, some of the we got unemployment today. We had a downgrade in the bonds. Like a lot of things were hitting. And were any of them the driver, or were we just at a point where we were kind of just getting exhausted?
No, well, I think there's that. I think we had the perfect setting. So people are on vacation. It's the summer doldrums. People are kind of bored and uncertain. Everything is very complex right now. I think that's the best word to describe. Things are very complex, meaning, what the Fed is trying to pay attention to, what individual investors are trying to pay attention to. It's almost like the dog chasing their tail. And we're really, as I mentioned last week, in a new kind of uncharted territory where, a lot of times we draw on our experiences and on history to understand what's coming next. And we really don't have anything to draw on because the setting is completely a new setting based on coming out of the pandemic, based on the supply stuff, based on the simultaneous skirmish in Europe. All of these things are creating a setting that nobody can predict what's happening. We've got, we're getting inflation slowly under control, but at the same time, we are having a strong economy. And usually when you try to put the hold onto inflation it's at the sacrifice of the economy. But so far, that's not the case. But indeed, we got a wake-up call when Fitch downgraded us this week, right? And really, if you look at the writing behind Fitch's downgrade, SIP, what they're basically saying is we're downgrading you because you guys seem effed up in your U.S. governance. So I think that, we've got all these headlines this week about the former president getting, I think business people, right, who generally, are they separate their business mind from their, everyday kind of, you'll hear people who are fiscally responsible but socially liberal or something like that. I think they're saying, oh my gosh, my business world is being influenced now by what's happening in the world. I better kind of reconcile those two, because Fitch basically said, yo, US, stop being so dramatic about things and get on track. Start thinking about policy and stop thinking about the drama that has been going on. And so, yeah, in response, the market got scared because downgrades are never good for business, and they sold off. I mean, looking at the technicals, you got a minute for me to look at the chart for a second, Sip?
It's up on the screen.
Okay, so what I had said for like the last 2 weeks is that we have a lot of resistance at 4,600. When you take a look at some of the quantitative NASDAQ level 4 data, what you're seeing is there's a lot of sell orders at 4,600. And in reality, what that is probably from, let me just give you a little bit of a history lesson here. When we had, I'll go back about 3 years. Let me go back a little bit further. I'm going to go 3 years ago. We had this. We had a market that looked like it could have no end. And so what happens when things are going up? People out there who would otherwise not get into the market are starting to see this, and they're like, oh my gosh, this looks like easy money. I'm having FOMO. I want to keep up with the guy down the street. And so they start piling in and creating this self-fulfilling prophecy of buying. And then they get to a certain level, and you've got all these people who probably shouldn't be investing in the markets. They have no experience, no education. They haven't taken my course or been part of my program. And they're jumping in with money into the markets. And then all of a sudden we get this, and they're left over here going, oh my God, what did I get myself into? How am I going to face my family? How am I going to keep this deep, dark secret for 18 months? That's what you can imagine is happening to these guys who like took a big portion of their family's investment portfolio and thought that the market would continue higher. So what do you think now that the market has finally, after all this time of sideways chop, started to approach that level? They're going to say, now's my opportunity to get that money back scot-free. I've been like being afraid to face my significant other for the last 18 months because I didn't want to tell them that I lost the family fortune. They're going to be able to get that back by selling what they bought over here. So there's a heck ton of sell orders waiting to go. And so as price approaches this level, we're going to see some selling, which of course makes price come back down. So if we ever want to get above this level, we have to have a strong amount of momentum that can, in other words, a strong amount of interest in buying to outweigh all the selling and finally get those folks who shouldn't have been in the market anyway cashed out, and more, just a little bit more buying than that in order to get above that level of resistance. And so that's my history lesson of what happened and why 4,600 has so much resistance. But we've been slowly creeping up. We started this current uptrend back in the beginning of March. It looks like I have down here March 6th, and it started off somewhat rocky. I remember when we were having this show, we were talking about how rocky it was, and then it started to build steam, as you can see here. In fact, we created kind of a more recent level of ascending support that I was wondering if it would hold. It turns out it did. That's this magenta level I drew in here. And we got up to that 4,600 level. And I've known about this 4,600. I've been talking about this 4,600 level, for the last 3 or 4 months on this show even. We went up to that level. We went up to this level of ascending support, and then we loitered up there. And I've been saying for the last 3 weeks, there's no way we have enough momentum, enough people interested in buying for us to get past that level. And sure enough, we were bumping up against that level and it wasn't going to happen. And I said, you know what? We need to have some distribution. We actually need to have some profit taking, bringing us back down to a level so that when we resume, we'll build that excitement again. We'll get investors, we'll get real investors, not some of these looky-loos who are on the sidelines, just feel like they're missing out and don't have any experience. We're going to get real investors to start buying in this latest expansion. And maybe that will give us enough momentum to outweigh this selling. And so sure enough, I had defined a level between 4,470, 4,516 that we needed to pull back to in order to like reload that gun. And sure enough, thanks to the Fitch downgrade, where we had that sell-off, we had some after hours on both days, after hours pre-session sell-off, and then we found a little bit of bottom. Look at where we found our bottom. We found our bottom right in that zone I said we would. My only thing that I missed on is I didn't realize that this Fitch downgrade, that was a little bit of a surprise. That was more of an accelerant, if you will. And I didn't expect that accelerant to come and bring us down in just one trading day, right? I thought it would take 3 or 4 days to get down there. That's why I was wanting to test this lower level that I have drawn by this cyan line, or if we would retest this more recent magenta level. But because we pulled down in just a single day, thanks to the Fitch downgrade, we now have the possibility for accumulation and kind of that snowball effect to get us above. So I'm kind of quite bullish about what's going to happen as we get towards the end of August, blast into September, get past Labor Day, get past the summer doldrums. I think we have a good chance of getting above 4,600 now that the market has done exactly what I said it would do.
And I guess my question to that is, what would be a driver that gets us above that, right? Because we're continuing to get pretty good economic news of this soft landing. And so would a Fed rate decrease, would that be kind of one of the things that could get us through that level through the end of the year? Because they've been hiking for 18 months now nonstop. And, you know, those effects are starting to come around.
So I think that would actually be an accelerant, possibly in the other direction. Do I think that's going to come? No, because the Fed doesn't have it under control yet. Like, for instance, if I bring our economic calendar, really the only thing of note besides that surprise downgrade by Fitch on Tuesday, the only thing of note really is today's employment situation. So let's delve into that. And this is kind of all telling, answering your question. So I know I'm making a short answer long here, but this is a very kind of confusing report. So in one degree, non-farm payrolls is slowing down, right? We expected 200,000. We got 187. Last time we said 209,000, but it's been revised down to 185. So we're we're still creating jobs, but not as much as expected. And we're kind of revising that number down. At the same time, unemployment is very low, 3.5%. That means that there's still this opportunity for you to like move around, that it's still kind of a worker's market versus an employer's market. But then over here, you can see that the participation rate is holding steady. That means there's about 2/3, a little less than 2/3 of the people who can work are working and are gainfully employed. That's great. But check a look at this number. This is average hourly earnings? How much is your paycheck increasing? And it's at 0.4%. So if I bring up a little calculator here, SIP, and I calculate this 0.4 times 12 months, let's make sure I'm on the calculator, 0.4 times 12 months, you're still at about 3.3% increase per year. And the Fed would really like to see that down at that. I don't know where it came from. That's always been a question, but at that 2% mark, and they're not going to stop. So I don't see, based on this confusing or conflicting employment report, that the Fed's ready to pull back. But now coming back to what I said before, the market, when we look at what's going on here, this uptrend had really no reason to be uptrending besides just the general setting of what's going on. So I actually feel like, based on my experience of looking since the beginning of March, that investors won't be stopped. Again, a Fed rate drop would be an accelerant, but now that we've pulled back, I think that there could actually be enough momentum, especially as we draw to close the end of August. So I think it's going to take 3 or 4 weeks, but I think that in 3 or 4 weeks, we might be surprised that we get above that level just organically.
All right. Well, we'll be keeping an eye on that. And as these tops form, using the tools of options, you can take advantage of it, right? So every week on the show, we go through a variety of situations. The past couple of episodes, we've talked about earnings plays, which I think are still pretty ripe now because we did just have some big names come out this week. And so that's going to start to settle down. Back to school, people getting back to the office, vacations ending. And so
more into the steady state.
Yeah, a lot of things are going to be coming back to normal in later August, early September. But in the meantime, we as options traders can take advantage. Time is to our benefit here. And so we want to just give everybody that's watching, listening for the first time an opportunity to learn a little bit more. AJ's got a wonderful workshop that runs every day. It gets updated every couple of weeks or so with real-time examples, explanations. And so if you're interested in learning a little bit more about how to take advantage of these strategies, we've got a link in the chat that'll set you up to get in there. You can play it on demand. You can watch it, within the hour, kind of based on your own, availability. And so this is a live show. And if you have a name that you want AJ to cover, feel free to throw it into the chat. We've got a few more things coming up. We've got AJ's pick of the week. We've got our trending topic, and we've got our speed round. And so we're going to go ahead and take a bit of a break here. We'll be back in a few seconds, and we'll be talking about our trending topic. So sit tight.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right. Once again, the link to that is optioninvesting.org/workshop if you want to sign up. Moving on to our trending topic of the week. I feel like this is a common question that a lot of new options traders tend to ask. And it's one that I even find myself asking myself every once in a while. And on the show, you've used the term a few times, but the trending topic of the week is, when you say legging into a position, what exactly does that mean? Legging. What is a leg when you talk about options trading?
Right. So a lot of our option strategies, remember, options SIP can be, they can be structured in up to 27 different ways, I think is how many the mathematicians have come up with. You can So with options, we have the choice of expiration dates. So we're going to use standardized options. These are the ones that are sold on the broad market. We're not going to have any custom options that you have to have, like a lawyer negotiate the contract on. We're going to use the standard options that are sold just like stocks. And so when you pick an option, first of all, there's the type, call or put. There is the strike price. So choosing different strike prices will actually make the option behave differently. Choosing the expiration date, whether it's one that expires in just by the end of the week or one that expires in 2 years from now, that's going to make the option behave differently. And finally, we can combine 2 or 3 options or maybe even a stock trade, combine them together to get these things to behave the way we want them to, depending on what we see in the broad market or what we see on the individual security. We can construct a multi-leg strategy that'll profit on that situation. Now, I use the word legging in because once you've planned out this multi-faceted trade that maybe has 2 or 3 or even 4 option trades in it, or different options or stock option combinations, you don't have to actually do the trade on all of them at once. That would be applying the strategy as is. And a lot of people do that. Like, for instance, a lot of folks are attracted to strategies like iron condors or vertical or calendar spreads, like we've talked about for our earnings play. That's where you put on all the option trades all at once. The other way to do it is to leg in, put on one part of the option strategy per time, let some time pass, let some movement in the underlying symbol or the option parts that you've already put in place happen, let them age or mature, and then add the other parts on gradually, and then take parts away and add them back, so on and so forth. In fact, that's what my big premium selling program is all about. It's about setting up a initial trade and then adding and subtracting the different legs over time to create income streams where you leave that initial trade intact and you're just constantly doing these adjustments. And when I say constantly, I don't mean daily. I mean like once a month. You're doing an adjustment on these positions and you're legging in. And so the timing on legging in is the real trick, right?
And I was just going to say that is basically the leg is time, right? Because options have, either you're buying something that's 6 months down the path, or something that's 3 weeks, right? They kind of work together, and you need one before you need the other, or you need the other to kind of coordinate, or just it helps alleviate the multifaceted movements, right? And time is one of those components, price is one of those components, and I guess it can be a little confusing for a newbie, right?
That's right. I mean, that's what my program participants and I probably spend the most time on, is when are we going to leg into each individual position? What's going to tell us? And a lot of times, and I know this because I deal with it daily, a lot of people make it more, you can make it more complicated or simple as you want. Simple would be just doing all the legs at once. Now, the benefit to spreading that out over time is if you do some front end analysis where you have for instance, my analysis on the S&P, I knew this was going to happen, this pullback and all of this stuff. So putting in some effort into the front end analysis and setting for yourself actual targets, what that does, if there's a good positive movement in your position over a short amount of time before you put the next leg on, what putting the next leg on later in time does for you is it increases the reward and it decreases the risk. But it does require that front end analysis, right? So a lot of folks question, should I do a lot of effort on the front end and then, just follow this trade plan and follow my price targets as the position matures? Or should I just throw this strategy on, let it do what it's going to do, and then throw another strategy on more as an active trader? And here's my experience, Sip. My experience doing it both ways over the last 2 decades is if you do that front end work, yeah, it's kind of a pain in the butt on the front end, but then you have not only these positions that have higher reward and less risk, but you also have positions that wind up lasting longer in time with less intervention, less adjustments. And so I have found doing both of them that if you can set up and plan a trade thoroughly on the front end, it's going to last longer and pay more and have less risk involved with it than if you're more active in the real-time trading, if that makes sense.
It makes sense. And if it doesn't, we'll continue to ask questions and try and learn along the way. Fortunately, we've got some audience tickers to go over.
Oh, cool.
We've got your pick of the week. We've got our speed round. So let's just dig into live examples, because that's going to be the best way to describe some of these examples and go through real life opportunities. And so let's just start with your pick of the week this week. And this is, I believe, this is a new name that is new to me. I'm not sure if we've covered on the show, but you said it's a perfect time to put together a trade plan for Centerpoint Energy, ticker symbol CNP. And why exactly do you feel that way, AJ?
Well, okay, so this is one of those. Let me tell you about the company. The company is mostly a power transmission company, not just electrical power, but they also, I think, maintain some natural gas lines. So they're not the natural gas producer or the electricity producer, but they get it from point A to point B. So they've got a lot of infrastructure. They're probably positioned well to get some money from the latest government spending on rebuilding infrastructure. So over the next years, they may see some influx in money to, update the grid. And so I think they do have some electrical generation in like some Midwest states, but it's a very small component of their portfolio. All to say, if what I just said to you sounds boring, it is. And that's why we want to sell premium on it. You can tell investors think that this is a boring company too. I'm looking at a year-long chart, and you can see that there's really been no asset appreciation. The stock price really hasn't gone up. It's just gone in this sideways choppy pattern between about $28 and $31. And that's okay, because we have option strategies that we can leg into that can profit off of this sideways chop. Plus, this company gives a really nice dividend, 19 cents per share every quarter. And so the investors who buy this stock, they're probably not pushing on the board of directors of the company to make their stock price go up, because they're fat, dumb, and happy making money off of the dividend. So this is a perfect type of stock for our premium selling strategy. Now, we can tell, like I said, that there's a level of perhaps resistance around this $28 range and support around the 31. I might have gotten those two words confused. Usually support's at the bottom, resistance is at the top. And we're right in the middle of that zone right now. And that is what I teach my program participants is the best time to plan out your long-term premium trade on this underlying symbol. So that's why I wanted to feature this, because now is when you do that front end analysis. Now is when you do your planning and you figure out what your price targets, what's going to trigger you to leg into the various positions that's going to make this into an income generator. So we're coming down across the center of the channel. Like I said, this is the best time when you're in the center of the channel, of a sideways choppy channel. This is when you can calculate what the worst trade is. The worst trade would be if you sold premium on this when it's in the center of the channel rather than legging into the positions on the opposite side. So we can actually do the analysis on what a trade place right here and now would do, and that would be your worst case scenario. We could say that would be the best reward we would get, and that would be the the highest risk we would take on, and we can size our position accordingly based on those numbers. But then we can also say we don't want to create that worst case scenario, so we want to make sure that when we're doing the one leg of our transaction, our underlying symbol is below that price, and when we're doing the opposite leg of that scenario, that our underlying symbol is above that price. And by creating those price targets for ourselves and creating whatever we're going to use to determine when the tops and bottoms are found, that's the planning we need, because then you've got this plan written down, whether it's written down on a piece of paper or on your hand or on a computer document, and you can just check in with the stock every evening. And when it's doing what you planned it to do, we always hear this term, Sip, plan your trade and then trade your plan. Now is when we want to plan our trade on CNP, so that in the next days over the month of August, September, October, November, we just have to execute our plan. So I would recommend that people spend the weekend planning their premium selling trade and how they're going to leg in and what size position they're going to create on this, because this is a great underlying symbol for that. And this is also a great time to do that planning process, so you can leg in accordingly over the next days.
All right. So that's CNP. We've got to
have it on your radar, folks.
Put it on the radar. Put it on the watch list. We've got a couple of names, so I kind of want to crank through them because people are eager to get your feedback. So before we jump into the speed round, let's go ahead and go through some live tickers. This is James, curious about CC. Is that Carnival Cruise? No,
this is I think it's pronounced Keymores. Let's see what I'm looking up over here on my other screen. Well, let's see what they do. Keymore offers their customers with solutions across the vast spectrum of industries, including plastics and coatings, refrigeration and air conditioning, mining. Now, as I'm reading this, right, the company's major products include titanium dioxide, refrigerants, industrial. Look like they're a chemical company, but they make chemicals for just everyday products. As I'm reading that, if you start to feel like you're getting drowsy and you're bored, that means that this is a good company to sell premium on, right? Because they're just a ho-hum company. Nothing special. They're not in the news, but all of their products, whether it be titanium dioxide in your sunblocks, on your reef-friendly sunblocks, or whether it's refrigerants in your air conditioning or things like that, this is the company behind it, right?
And so do we have opportunity? What do you...
Absolutely. Look at this. And this was not on my radar either, but it's going to be. I can tell right now. We'll take a look at the option chart. But look, it's a company that's going to be around for a while because, look, they make money. I'm looking at their earnings. They didn't lose money, but they didn't make money that quarter. But they've been making money. And look, I just got through saying how nice it is when your company gives you as an investor the dividend. Look at that dividend, 25 cents per share. Any investor who's interested in Keymores would be happy just owning it because you get a paycheck every quarter. So with that said, let's look at the option chain. The pattern looks fantastic. It looks like a sideways choppy pattern. I'm looking over here. I'm going to look at the January 2024 option specifically because this is an option I would use as my protective leg, my protective option leg. And my protective option leg, SIP, I'm going to be buying and selling. So I want to make sure that there's liquidity in this particular option chain, both on the call and put sign. And I'm also interested in the increment. And so you'll notice it's trading every dollar. A lot of the options trade every $2.50. This one trading every dollar is a benefit because it means I can get really granular with how I construct my strategy, right? I can get down to the dollar, which is just fantastic. And then there's liquidity. Look at the bid-ask spread of these at the money and out of the money options. 10 cents, 20 cents between the bid and ask. That's telling me that indeed there are people trading this. The open interest doesn't look bad either. There's people trading it. I'll be able to buy and sell. The underpinnings of this symbol are fantastic. And then as far as timing goes, yeah, we're right here at our level of resistance, which is around $36, $38. There's a zone up here. It looks like that, the investors are, whenever they see it get up to that level, they start selling because they don't think it's going to get any higher. So it creates a self-fulfilling prophecy on resistance. We've got support somewhere around $28. Now is when if you're not already in this position somehow, now could be a reason why we want to short the underlying symbol. So shorting the underlying symbol means that we'll make money as it goes back down to the level of support. So you can either short the stock, or we can buy a deep in the money. So that means, strike prices way in the money, far out in time. And I'm thinking June, something like that. June 2024, I should say. Let's go at least 8 months out. And that would be a put option. So by buying that, you're going to incorporate a little bit of leverage. And in addition, it's going to profit on the symbol going down. And that alone, as long as the symbol is going down, is a great trade by itself. If it bottoms like we think it will, around this 28, even going down to $26, if it bottoms and starts to go against that initial position, that's the timing for the legging. That's when I want to go ahead and sell my put premium. So I'll make some money off of that instantly. I'll use that money to then fund a out of the money call option, and the strike price would be up here. That will be my protective option. But as a side effect, not only will it protect me if something goes wrong, right? It will also profit as it matures. So I'm going to get profits off of the premium trade. That's as time passes by. But I'll also have profits on rolling out that protective option because I did leg into it at a different time. So yeah, I'm a fan of this, and I think the timing is right. Because this symbol is new to me, I'm probably going to do a little bit of paper trading on it, see if the plan I put together on it, actually works, right? I'll make sure that my signals work. And the only way to really know for sure is to try to trade it in real time. And to trade it in real time with no risk means you're going to use a simulator or a old-fashioned paper trading log. I would probably do that. If you've got experience and you have been following this for a while and you understand the ins and outs and feel comfortable, you might throw some real money at it. But I need to, and I would recommend anybody else who doesn't have a lot of familiarity with this stock, do some paper trading, test your plan out, test your indicators out that you're going to use for timing. Make sure everything's all in alignment, because it looks like you've got months that you'll be able to profit off of this.
All right, so that's CC. That's a live one. Let's just run through another live one real quick while we have the people watching. Ticker symbol JOBY. I am not familiar with this one.
No, me neither. Let me just pull it up and see if I can read a little bit about what this company. This is Joby Aviation. Let's see what the Joby Aviation. It's involved developing all electric aircraft for aerial ride sharing. That's very interesting. Speaking of that, I was again reading the comparing and contrasting of Tesla versus what's the other
Rivian
self-driving company?
Oh
no, that's a car manufacturer. I'm thinking of the full self-driving. It's like Waymo or something like
Waymo,
that.
yeah,
Waymo. So the difference is, I was looking at a comparison of the technology, and one of the things that came up for me in that discussion was the underlying aim of the company. So Waymo is a ride-sharing company, and so they want their self-driving so that they can then sell rides. Whereas Tesla is a car company. They want to sell cars. So, Elon has made this push, and I know I'm off the topic, but Elon has made this push towards, no LiDAR. But when you think about it, he doesn't want you to actually be self-driving the cars. He wants to sell you a car that's going to have enough to make you buy it. He wants to make his cars interesting enough, whereas Waymo wants to sell rides. And so in order to fulfill their business model, they need to get the drivers out of the business. They need to not pay drivers. So their technology has to be like fail proof, So it's just interesting. That just came to mind as I was reading about Joby. Joby wants to sell rides on these aerial rides. I'm kind of excited because the company is based in Santa Cruz, California. I lived there for 3 years. And for me, it was heaven on earth. And actually, my wife and I are looking at places constantly on the internet to see if we can get back there. So I kind of like that too. With that said, I'm a little bit nervous already on Joby Aviation because they're cutting edge. They could possibly, if they make a breakthrough, possibly be in the news. This is something that is not what you want for a premium selling trade, because premium selling trades, you want that boring, consistent, sideways, choppy pattern. And I can already tell that this is not a boring, sideways, choppy pattern. So you'd probably want to trade this differently. And because it's so cutting edge, it's going to be hard. It's a very speculative play. It's going to be hard to know what's coming next. It's going to be surprise after surprise. I probably would not have this in my portfolio, except for maybe having some fund money, or if I wanted to fund a new technology, thinking that perhaps, I wouldn't get any of my investment back on that. But I'm not sure I would create some sort of trading strategy on this particular company. Now, if you want to pick up some of this stock, like you think that this is going to be a good company, you want to support them, instead of just buying the stock outright, let's look at the option chain. Let's go for a near-term option. They're trading like every couple of bucks. And what you're going to do is you're going to use a cash secured put strategy. I love this strategy. So you pick the price that you're willing to pay for the stock. So say, for instance, I'm willing to pay $7.50. The stock is currently trading at $8.37.5. I'm going to sell this naked put. This put is going to expire on August 18th. So between now and August 18th, first of all, I'm initially going to get 15 cents a share. So just by making the arrangement, the agreement that I'll buy this stock at $7.50, I'm going to get 15 cents a share. Now, between now and August 18th, I may or may not get that agreement filled. Somebody may or may not sell me their stock for $7.50. Either way, I keep the 15 cents per share. So here's a scenario where this is so much better than a limit buy order. This is like a limit buy order on steroids. I get to specify the price I'm willing to pay. It may or may not go through, but at the same time, instead of just putting that order out there and saying good till cancel or good for the day, I'm putting the order out there. I'm saying, in effect, good till August 18th. I could also do this with weekly charts. My display is only showing monthly, but I could do this where it expires every Friday, and I'd be willing to pay this amount up through the Friday expiration, and I'm getting paid for placing this order. So I would, if my main goal is to own some of this stock and support the company, instead of just buying it outright, I would use this strategy because I could lock in the exact buy price and at the same time create some passive income off of that by placing that order. Not many people understand or know that strategy. It's a very easy strategy. And if you know this strategy, you'll never place a limit buy order again. You'll do it this way because this way pays you to place that limit buy order. I love it.
Just a follow up on Joby commentary is that Uber and Lyft have interest. And so that could spice things up a little bit more with acquisition takeover and just being a name that's in the news.
It
So
makes
yeah.
sense.
All right. So love the live questions, but we still have a few in the speed round from this week. Let's see if we can.
And we don't even have to get through all of them if we don't
Yeah.
want
Well, let's just see what we can do. If there's opportunities,
to. Yeah.
we'll dig into them some more. If not, well, better luck next week. So let's go ahead and head down south. And this is Susan in Galveston, Texas, interested in Yeti, ticker symbol H or YETI. I believe this is the microphone manufacturer, right?
No,
No,
Yeti is coolers.
coolers.
And cups. Oh yeah, I've got a Yeti cooler. In fact, I got one of the limited edition ones in orange. That's kind of the dad in me. I freaking love my cooler. It stays cool for like 3 or 4 days. You put ice in it and it's like made like a tank. It weighs as much as a tank too.
Well,
But
it's
yeah,
not.
this is the cool they make.
So it's boring. So there's gotta be a trade on the horizon. What's
Although
the
I
deal?
have to say my wife has been noticing that, like, my wife is really into these things. It's called on trend, which I had no effing idea what on trend meant. But that's what happens when you marry somebody who's like way into like fashion and stuff. So apparently on trend right now are these backpacks you bring to the beach that are Yeti coolers. Anyway, she keeps pointing them out to me every time we're at our beach house, that we need one. But yes, coolers are boring. This company has been coming onto the scene in a strong way in the kind of camping outdoor market for the last 5 to 10 years, and they're really coming on. But in the meantime, it is coolers. Listen, they're going to report their earnings, Susan, on August 10th. So it looks like every time they report their earnings, you possibly could create one of our earnings trend. You go watch the YouTube shows from the previous couple of weeks or program where we've talked about how to specifically do that. I don't think we want to revisit that today, but I would not set up a premium trade until August 10th. So August 10th, the morning of, they're going to do earnings. Let's get that out of the way. If you're going to do an earnings trade on it, great. Get that prepared this weekend so you can do it next week. But in the meantime, it is positioned well for a potential premium trade once that earnings is released. We're at the top of its channel. Once it's given us the signal that it's done topping out and it's ready to go down, we'll short, just like I explained on CC. We'll short the symbol either by actually shorting the stock. And don't forget, if you're going to use the stock, you have to buy it in lots of 100 because options are traded in lots of 100. There's an option contract, and an option contract means 100 option shares, which is analogous to 100 stock shares. So if you're going to use the stock, make sure you do everything in lots of 100. So you could short the stock if you have a margin account. Shorting is straightforward. Or we could buy a deep in the money, far out in time put option as a stock substitute, as shorting the stock substitute. And you can do that in a cash account. So for those of you who want to put this in your retirement account, that's a great idea. That's where we are in the timing of trade. That position alone will profit as the underlying symbol goes down. And then as the underlying symbol finds its feet, probably it looks like historically it's going to find its feet around $35. As it shows us signs that it's ready to start finding a bottom and it's going to start working against that short position that we put on when the underlying symbol was up here, that's when we're going to sell our put premium. We're going to leg in by selling the put premium and buying the protective call with a strike price probably up here at 44 or 43. Let me see what the strike prices are. Again, for that protective option, I'm going to be looking at the January. Okay, it's every $2.50. Remember I said increment makes a difference. So yeah, we could use 42.50 or we could use 45. I'd probably use 42.50. But I wouldn't place that protective call trade until I needed to. So I'll leg into it in the future sometime. Right now, I'm all about putting on the initial covering position. I'm going to wait for earnings. I'm going to wait for solid indication that a top has been found, and then I'll go ahead and do that.
Yeah,
I like it.
I think a common lesson here is keeping an eye out on that earnings date and letting the excitement end before putting on some of these positions. And so that seems to be the case with Yeti. All right, Susan,
Put this
thank you.
one in your portfolio, Susan. I like it.
Boring. We love boring. Yeti coolers. That's as boring as it gets.
On trend.
Yeah. All right. Moving to the west side of the country. This is Maria from Bakersfield, California, interested in a name that we cover frequently, and that's American Airlines, ticker symbol AAL. What's going on with the airlines, AJ? Ain't any money to be made.
I mean, look at that earnings, $1.92 a share. And even though they had positive earnings, investors sold off. So maybe you go back and you kind of do the summary of the earnings. You could actually go and find the official filing and find the transcript of the summary. And for those of you that have been playing around with Bard or Chat GPT or the new one Llama 2 out of Meta, out of Facebook, put that earnings summary. It's usually a lot of pages of geek speak into your AI and have it summarize it for you. Find out what the heck happened. It looks like even though they made $1.92 a share, that wasn't good enough for investors. Still, we know American Airlines is boring. This is one that I actually have in my portfolio that I constantly am selling premium against. We're getting to the point where we've almost missed our opportunity for setting up an initial position. We should have done it when it was trading up at $18 instead of $16. So here's my recommendation on American Airlines. Take some time this weekend, maybe next week, and plan out your trade. Just like I'm doing with CNP, let's take our time and plan out the trade on American Airlines. What price do you want to try to buy this thing at? So I'm suggesting you wait, and once it bottoms out, that's where we're going to buy low. So you're either going to buy the stock or you're going to buy a deep in the money, far out in time call option, which is going to act as a stock substitute. And then let that position appreciate until it tops. It looks like this latest top at $19 was a fluke. It's more like going to top around $17. Let it top out. That's when you're going to sell your call premium. Use the money you make from selling that call premium to offset the purchase of that protective put, and then roll out your protective put as it cycles. And you'll create that trade that just pays you back over the next months. It's going to be a wonderful trade. But in the meantime, let's take some time to plan it out. The timing for actually running this position right now is a little bit off. So let's not do anything this week. Instead, let's get our ducks in a row.
All right. American Airlines, a popular name. And we do have some time to get to our very last speed round question ticker. And this is John from Duluth, Minnesota, on topic with the ongoing writers and actors strike. He's interested in Fox, ticker symbol FOX.
Fox Entertainment or Fox Corp. Fox Corp. Okay. Did they skip a dividend? No, it looks like they give a dividend every 6 months rather than every. So it looks like it's time for another dividend. Last time they gave a dividend was on August 30th. So maybe there's a dividend that's in the schedule here. Let me zoom in a little bit, maybe to a year.
Writers and actors that are unhappy, but we got to keep the shareholders happy. They need their dividend.
Company makes money. It made 94 cents per share this last quarter, despite I think that they have a huge settlement that they have to pay out to some of these people for some misinformation they gave. Whatever, doesn't matter. They are sideways channeling. Let me see the activity on the options chain. They're trading more traditionally every $2.50 up to $25 and then every $5. So let's look at that really quick so up to $25. So that's roughly here. They're basically trading every $5. And the question is can we create an option strategy given those limitations? It's a little bit hard. It looks like we would prefer if it was traded every dollar or every $2.50. Instead, we're stuck with 35 and 25, which is a huge spread, or the 30, which happens to be right in the middle of the channel. So because of the option chain limitations, this is going to be a little bit harder one to trade. Not impossible, but more difficult to trade. The pattern looks fantastic, right? It's definitely bottoming out here at $28. It's definitely topping out here somewhere around $32. I think if you use a point and figure chart, you would be able to see exactly where that support and resistance levels are. Just on a side note, another tool I like to use is a price by volume chart. That's where you see these histograms of buying and selling volume coming out at each price increment. So you can see where all the buying and selling is, because that's where your levels of support are. So these are some ideas for other tools for determining where support and resistance are. With that said, we're at the top of the channel. It looks like it's loitering up here. As it goes down, you could set up a short position on Fox. You could buy some deep in the money, far out in time put options if you want to incorporate some leverage, if there's some liquidity out there. Let that thing fall. Once it bottoms out, that's when you sell your put premium, buy your protective call option. And again, you can get as specific or as general on those timing indicators that you use. Just make sure you're more than halfway down from the top to the bottom. And placing that trade wouldn't be a bad thing. That's a perfect way to determine where to leg in if you want to do this kind of short and sweet.
And sometimes AJ likes the trades. You like the trades a little bit more than others. This one is probably one of the others because of the
increment.
The increments aren't as favorable to history in your 20 plus years of options trading. All right.
Yeah.
Thank you.
There's lower hanging fruit out there, John.
Yeah, thank you, John, for bringing that up. That does conclude our speed round. We've got some live tickers that we ran through heading into the end of the show. Before we close things out, we do want to give everybody a chance to sign up for AJ's one-on-one training program. So if you've enjoyed the broadcast and you're interested in learning a little bit more, but you want that hands-on attention, AJ's got a fabulous one-on-one training program. We've gone ahead and put the link into the chat. So if that's something that you're interested in, head on over there, sign up, have a 5-10 minute conversation with somebody, get the answers that you need, and see if it's a good fit for you.
I see me as you're talking. I see my little video playing and I see my little hands going up and down.
It's always, hey, it's
hey,
the excitement of investing in options, and
it really is exciting, by the way.
It's exciting to take ownership of your own destiny, right? It's exciting to learn, and we're in a day and age now where there's so much information, there's so many tools, the accessibility is there, and one can be proactive in taking advantage of whatever portfolio they have. A few $1,000s, we've got strategies to help you take advantage and not be so careless with the risk taking. There's a lot of thought process provided in all of this. So all right, AJ, first week in August, the summer doldrums are ending. What should we be keeping an eye on heading into next week? Anything particular stick out for you?
I mean, I'm just excited again because of that pullback in the broad market and all the other symbols are kind of pulling back. It's queuing up a lot of trades for us. My screeners for my program participants have been going off usually they're doing this on the Geiger counter and now they're doing this on the Geiger counter. So we've got all these opportunities. I'd say, get your feet wet, start the paper trading process, start the planning process, get comfortable. You're only going to get very good at this passive trading if you do it, if you get in there and run through your paces. And that's what I would say. That's what we want to do through this whole month of August. So this weekend, plan out a few trades, get your trade plan in place, and then trade your plan.
All right. If you've enjoyed the broadcast, hit that like, hit that follow, hit that subscribe button. If you have any questions on any of the names, any of the positions, feel free to leave a comment, send us a chat, a DM, and someone will get back to you as soon as possible. Otherwise, stay safe, enjoy the weekend, and we'll see everybody next week.
Sayonara.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content